If you ask any credit analyst to name the single most important ratio in commercial lending, chances are they'll say DSCR because it tells you one simple truth. Can the borrower comfortably repay the loan? Hi folks, I'm Sandeep, a business analyst working in wholesale credit. And in this video, I shall explore one of the most critical metrics in commercial lending, the debt service coverage ratio or DSCR. Whether you work in credit, risk, real estate finance, or banking analytics, DSCR is a number you must understand inside out. What is DSCR? DSCR measures the cash flow available to service debt obligations. The formula is simple. DSCR is equal to net operating income, NOI, divided by the total debt service, where NOI is cash that the asset or the business generates. Total debt service is the principal plus interest payments due in a year. Why is DSCR so important? Because it answers a fundamental question. Is the borrower generating enough cash to comfortably repay their loan? A DSCR of 1x or 1 time is just enough cash to pay the debt, no buffer. Below 1x, borrower cannot meet debt obligations. 1.2 to 1.5, ideal range for many commercial loans. Above 2 times, strong cash flow, low risk. Banks prefer higher DSCR because it means less stress, more predictability, and greater resilience during downturns. Let me give you a couple of examples. The first one from commercial real estate, that's where I work. Let's say a property earns $1.8 million in annual net operating income. Its annual debt obligations, interest plus principal, totals $1.2 million. So the DSCR is 1.8 divided by 1.2, which is 1.5x. This means the borrower has a 50% cash buffer, which is very healthy. If rental income drops by 10% during a recession, net operating income becomes $1.62 million and DSCR becomes 1.35x, which is still very comfortable. This is why lenders rely heavily on DSCR in commercial real estate, especially in offices, retail centers, warehouses, and multifamily properties. Another example from the manufacturing sector. A manufacturing company generates $5 million in EBITDA. More on EBITDA in my next video. After adjusting for taxes and capex, the cash available for debt service is $4 million. Its yearly debt obligation is around $3.6 million. So DSCR would be 4 million divided by 3.6 million, which is 1.11x. This is technically acceptable, but the cushion is small. Any drop in revenue, even 5 to 7%, can push the DSCR below 1x. This is why banks often set a covenant requiring the borrower to maintain a DSCR of above 1.2x to provide a safe buffer. Now, let's talk about stress testing, the real power of DSCR. Banks don't just calculate DSCR once, they also stress test it. For example, what if interest rates increase by 200 basis points? What if rental income drops by 15%? A DSCR of 1.2x might fall to 1.5x, triggering early warning actions. This helps the bank identify potential covenant breaches, need for restructuring, whether to renew or extend facilities, or whether pricing or collateral needs adjustment. DSCR is not just a number, it's a risk forecasting tool. Okay, then, so let's summarize what we learned today. DSCR measures ability to repay debt from operational cash flows. Higher DSCR is lower risk. Banks prefer about 1.2 to 1.5x, depending on the sector and the asset class. Essential in commercial real estate, corporate loans, and structured finance. It's used for approvals, covenant setting, and early warning monitoring. Well, thank you for watching, folks. I am Sandeep, a business analyst in wholesale credit. In my next video, as I mentioned, I'll break down EBITDA, the simplest way to understand a company's true operating performance. See you soon.